Welcome back to World Crisis Radio. We're following the process by which the role of the derivatives as the main cause of the current world economic depression is unveiled. So Robert G. Wilmer's Washington Post this week, at the heart of the financial crisis lie the complex, opaque derivative securities created not by Main Street, but by Wall Street with the passive complicity of regulators. And let's see some other interesting news on the derivatives front. Associated Press today, July 31st, Metropolitan Life Insurance Company, right? Snoopy the dog, Peanuts. Metropolitan Life Insurance Company, MetLife, has posted a whopping $1.4 billion loss after a huge spike in investment losses. A year ago, they'd made almost $1 billion. This time, they lose almost $1.5 billion. Revenue is down. Why is this happening? I'm quoting now from the Associated Press. Losses were largely driven by losses on complex financial instruments known as derivatives. Derivatives are used by MetLife as a hedge against changes in interest rates and foreign currencies. Now, this tells us what we need to know. The destruction of insurance companies, the entire healthcare debate is a lunatic debate because it ignores the fact that most of these insurance companies are bankrupt. They are bancarotto. Those are bankrupt companies. They're gone. They are zombies. They are derivatives monsters that have blown up and turned into black holes. We're just hearing now that inside the AIG group, where we had the $3 trillion of derivatives launched by the AIG London hedge fund, this is the case that is best known from the crash of 2008, and now we're in the crash of 2009. The AIG component companies, and there are 71 component companies of AIG, they're doing very badly. The dirty secret of the healthcare debate is that on Obama's side, the goal of Obama is not to create government health care. He does the opposite. Obama had no interest in single payer, nothing. The government plan, something like Medicare for all, is going to be dropped by the wayside. That's going to be part of the compromise with the Baucus Senate Finance Committee on the one side and the House on the other. So there's not going to be single payer. There's not going to be a government plan, the Medicare for all if you want it, which is the one that I would recommend. What's going to happen is a plan by which more and more Medicare money, Medicaid money, federal government money, and your money are convoyed not to government, but to the private insurance companies to help them hide the fact that they are bankrupt. AIG is bankrupt. A couple of more quarters like this, MetLife is bankrupt. All of these companies are getting money either off the TARP, that would be AIG, $180 billion, the single biggest chunk. We also know that MetLife undoubtedly getting money under the table from the Federal Reserve. And remember, the Hartford, officially, this huge complex of other insurance companies, getting $3.5 billion off the TARP. Other companies like Prudential, Allstate, State Farm, and so forth, decimated by derivatives speculation. So when you say private medical insurance, you're ignoring the fact that those companies are just about 100% bankrupt. They're gone. So revise, Austrians, your view of the insurance problem. The idea that there's automatically going to be a private sector there that's going to exist on its own and provide medical insurance is simply baloney. There is no private insurance sector left. It's gone. These zombie companies, the various AIGs, Hartfords, MetLife, Allstate, State Farm, the rest of them, and their health insurance subsidiaries, right, Connecticut General, and all of them, have all driven themselves into bankruptcy with derivative speculation. These are the realities. Obama's goal is to try to bail them out in a slightly different way by permanently attaching them to the federal budget and to your wallet and your pocketbook. let's just look now at some of the economic data. There was big expectation today for the GDP figures, gross domestic product, released this morning. We're told what happened in the second quarter of 2009. There was big expectation that this would show that the recovery is here. Well, despite Newsweek putting the recovery is here and the recession is over on their front page, if they still have a front page, Newsweek practically does not exist anymore as a paper publication. They're succumbing to the depression. But now we're told that the U.S. economy shrank by only 1% in the second quarter, meaning that between the minus 6.4% of the first quarter and the minus 1% of the second quarter, somehow we come out with a decline of about 1.9%. The contraction in the first half of this year, 1.9%. Now, a lot of people trying to spin this as good news, but the markets have not seen this as good news. And the markets, of course, as we know from our Austrian friends, are infallible. But it is interesting to see what they think. What has happened now is that the dollar has taken a tremendous dive. The dollar has lost 1 2/3 euros, almost 2 euros today. So the dollar is down almost 2 euros in one day. We're now at the dollar equal, or basically, if you want to get a euro, you got to put up 1.42 or 1.43 U.S. dollars. The dollar has also lost a full yen compared to the yen. This is bad news. The recession is not over. It has its changes in the rate of collapse, but nothing to write home about. Now, the question of hyperinflation, of course, is posed by the fact that the stock market has gained 10, 12% in the last 2 to 3 weeks. For all we know, this could be the beginning of hyperinflation. What you've got to do on this is to watch oil. Oil is now hovering just below $70. That is the latest figure from the London ICE futures market. In other words, a oil derivatives market, which seems to be the world leader, supported by Goldman Sachs and Morgan Stanley. U.S. interest rates are certainly rising. I mean, over the year, the interest rates were 2% at the end of December. They're now up to 4.5% on the 30-year bond. Otherwise, you want to watch the Commodity Research Bureau, which spiked upward today, but we need to see a long-term trend, which we do not quite yet see. Looks like hot money has been headed into the stock market because that is what the boys decided to put up. But other than this, do not look good. The dollar index now at 79.24. In April, it was at 87. Now, it's bounced around in the meantime, but certainly a significant decline of 12% or something like that on the dollar. This week, the Treasury sold $200 billion of U.S. Treasury securities, and they seem to have gotten through the week. But how long will that go on, especially when the dollar is falling against the euro, falling against the yen, and today the dollar broke through some key technical support levels, going down on the downside, as they say in the trading pits. The dollar, I think, now deserves a prolonged scrutiny to see if the dollar hyperinflation is expressed there in a continuing fall against the dollar, which has been going on, I think, all this week and last week, compared to the euro. So too early to call hyperinflation, but we have some harbingers. We do have some straws in the wind. Now, the other question, healthcare debate. Look up the remote area medical health clinic. They went to Wise, Virginia. I'll be talking to you about this now in the second hour. You want to get an idea of what healthcare looks like on the ground in rural America, in Appalachia. Get a load of the RAM, Rural Area Medical Health Clinic. We'll be back in a minute.